Good evening. This is the Eye of the Storm podcast with my big picture update for the S&P 500 for Sunday, July 3rd, 2022. First, I want to wish everyone a continued great weekend, and I hope everybody's enjoying having a summer holiday. And I hope it's warm and it's sunny and that you're with family and friends and enjoying yourself with one more day yet to come. I'm going to present my big picture update for the S&P 500. I'm starting here on my maximum chart, but that's for the cash market, for the S&P or the SPX. So the cash index is where I have all of this extreme long-term information. And it goes back to 1928, basically. So the very large count is what we're going. And I get comments from a lot of my subscribers on YouTube, and that I really do enjoy. I enjoy getting them. It engages a conversation that is educational and revealing to both me and for subscribers. And I am always up for engaging in a conversation. And so I enjoy it very much. Anyway, to just pick up there, I want to present a technical picture. And in doing so, my subscriber came back and basically was talking about that while the current wave took over 70 years to complete, and that would be this supercycle wave 3 sitting way up here. Here's 1 and 2, and this whole thing is 3. And it definitely was, I believe, like 90 years in length, 90 years. And so getting all that and trying to put that and wrapping around in just a correction and the whole phase indeed can be a little bit overwhelming, because you got to try to take that and shrink it down and to put it into a 6-month picture, a 3-month picture, a 6-year picture, a 20-year picture, et cetera, et cetera. And that takes a lot more planning, data, and just mindset. So right now I'm showing you the length, but I am actually only concerned in basically this part of the correction that we're going to be going into. Ultimately, I do believe that the S&P gets back to the price territory of the fourth wave of one lesser degree. If this is a supercycle wave 4 correction, it's going to find its terminus, its endpoint within the price territory of the fourth wave of one lesser degree, which is the cycle degree, and that one is right there. And that low was at I'm calling it 667. That's what I'm calling it. And I, over my years of using Elliott, have expanded that generalized guideline to include the price territory of the previous fourth, particularly on the size of what this correction could be. Now, having said that, the question that my subscriber asked me is that it was very hard to understand how a $45+ trillion exodus from the equities markets is supposed to happen. And my response was that I feel that your questions and comments are great and present valid questions and concerns. So let me attempt to add some thoughts that you might want to consider when we're thinking about how $45+ trillion could exit the markets. So I started by asking that I wasn't sure how we arrived at that 45 trillion plus number that would be leaving the markets, but I would like to know if we can do the same math, which we can, to figure how much the markets left in how much money left the markets in 3 short weeks back in March of 2020. And then how much money was put back into the markets via quantitative easing, which actually went to infinity, right, over that 2-year period. Also, and this might be the more difficult part, how do we estimate how much of the gains over these last 2 years were due to over-evaluations on hopes that a continued extreme pace would continue for the run to grab the gold ring, to get to that high. So irrational exuberance for sure takes partial, if not all, of the blame for what we're now going to be confronting. So also we need to consider what happened back in 2009. 2008, 2009. That happened pretty quickly. We were all in this nice little bull run, and the Dow was making new highs, and boom, we go into this very destructive, very hard C wave down, very like, oh my God, what's really happening type of a C wave down, as the US economy and other places went into meltdown, particularly in the United States because of mortgages and positions on these mortgages, et cetera, et cetera. And it took out Bear Stearns, Lehman Brothers, a lot of smaller banks, a lot of smaller firms, et cetera, et cetera. They all went by the wayside. So again, that did end up adding to the total of how much money left the markets at that particular time. So also, during this time in 2009, the S&P lost 38% of its values. So on the cycle degree, that wave 4 ended up putting in a 38% drop for the S&P. So 38% of its value gone. And so it's easy enough to figure out because we have to go look up to see what the value was at that particular time. Now, moving forward from there, I take it that we really are correcting to begin to start on one level down is the cycle fifth wave that we're going to be correcting. And now based on inside of that, I'm now looking at the next level down, which is the primary level. So there's the primary fifth wave. So I'm just basically putting in some basic what levels I believe we're correcting to, and then we move to the next, and then we move to the next. And so what I'm really doing is the first one up as I'm looking at the intermediate degree to form the primary degree, to form the cycle degree, to finish the supercycle degree. So that's how I'm working it up, all those particular levels. Now back to what I also included in my response, that once we also take note that from that low in 2009, or even if I'm going to 2020, but it actually was 2009, that is where the market began to launch its historic journey up to these all-time highs. It was basically off of the 2009 lows. So what is important to understand, and what I try to explain, is that if Elliott Wave analysts don't have a crystal ball to tell any of the who, what, where, when, or how, because Elliott doesn't provide that, neither does the Fed chair, who basically at the time was saying, and has said, that he thought, well, this would all come under control. We can get inflation back to where we want it, maybe within 2 years. Well, we're not there yet. Now, what do I have to compare in terms of interest rates? When we're looking at the big picture, what do I have to compare? I can compare 1981. That's the last time interest rates peaked and bond prices bottomed. Now, what also do we just find out from last week? That our inflation rate today in 2022 is 8.6%, which is, according to sources, the highest in the last 40 years. Well, 40 years ago, gee whiz, we're right there, 1982/81/80. And if that's where inflation was back then I want to take a look at, okay, what brought it up to that level would be interest rates. And then, so what actually stopped it there to allow inflation starting to go back down. Interest rates at the time in 1981 peaked at 21% for the Fed funds, 21%. And right now, I think, what are we at? 3, maybe 4? It's like, hello? So in 2 years, we're going to get a hold on inflation. Inflation might get a hold on us prior to that. And if they release the grip on inflation via not raising rates, it'll, in my view, it'll present us with a disaster. It presents us with then a likely crash. Because what we're attempting to do is to reinflate something that should not be reinflated because the underlying reasons have not changed. The underlying bias has not changed. Inflation would not have been controlled if we turn around and try to reinflate this with borrowed money. So you're going to be doing it at a higher interest rate. You're going to be doing it at a whole different set of givens. So we need to put this all together when trying to determine why would the market go higher. More on that if you just step out from a big picture update and start listening to my dailies. So again, my opinion is that the Fed, as a group, they can model the future. I don't see how they could model the future when there is so much uncertainty and the status quo, the way it's always been, the way history tends to repeat itself for those last 90 or last 60 years. I just showed you that big chart that showed for 90 years, we had an up phase. We had some yes, we had a nasty economic collapse, we had a pandemic. I can go back to we had the 87 crash. I can go back to we had then all the way back to the 1929, 1932 period of depression, periods of recession, which is kind of what we went through in 70 to 74. There's all those periods, they were all included in this generalized uptrend. And now we're going to correct it. That same correction is going to have serious downside, but it's going to have up in it as well. And because it's extended over a period of time, I would suspect we get to rally for months in between. So there will be definitely two-way trade, but let's just get serious about what's going to be causing it and what seriously we need to look for to get confirmation that, oh, we are healing, we are getting better. So going on with how I group this all together is that if we take all of that, what I just said, the status quo, the uncertainty, et cetera, into place here in the US, it's not our problem alone. It's a global problem that continues to get aggravated by the geopolitical disruptions that are occurring around the world. So least of which is global warming, folks. So once again, we as human beings tend to be very short-sighted. And I have to include our Supreme Court on this one because of what they allowed in terms of fossil fuels. So we're thinking that everything will be just all right or fine. So once we have view of these numbers and thoughts that I'm talking about here, it might just become more clear and how that 45 trillion might just evaporate. So, but I also feel it's important to realize that most people at the time, and I asked my grandparents, remember I'm 68, so my grandparents were alive in the crash of 29 into the Depression. And I asked them about that, the 29 crash or the ensuing global depression that came after it, and that most people didn't see it coming. And yet it did, and it devastated the global economies. Again, here we are again. People didn't see the seriousness of the COVID pandemic, and many still don't. But nonetheless, it has happened, and it shut down the world economy basically for 2 years. So how we recover is to first recognize and adjust to the inability to return to normal as it was prior to COVID's arrival. the recovery from the damage created by COVID has begun, but by no means is anywhere near producing a widespread recovery yet. So that's the editorial feature of my big picture update. Now let's take a look at this technical picture, which I've already started. That what I'm working is sections of this larger correction. The whole thing ultimately, yes, may end up back in here somewhere. And if we think this was 38%, if we take 30% of this entire huge rally, then we might come up with a much different number. But I'm approaching this a little bit differently than what I think many other people may. So first of all, again, here we are, super cycle, cycle, primary, intermediate. I'm in the intermediate part. So what I'm really just thinking that I'm correcting right now, so I can get intermediate wave A in here, is I'm correcting primary wave 5. And I think primary wave 5's correction in an ABC on intermediate degree is going to give me an ABC down to produce primary wave A. Again, I just went over what I'm basically looking at here. We have our degrees. I'm starting with this. Here's the first ABC. We're finishing this ABC. That'll put in a primary A. That primary A is going to really be the correction of the primary fifth wave up. So it's just how we try to figure how all of this is going to unfold. So I'm looking at a chunk of time, March of 2020 to March or when our tops came in 2022, how much should I correct? I actually think we're likely going to come back down to in between here and here on this particular move. Now, I can do this a couple of ways. I can put that entire high in, and that would be 48.08. Then I just rounded it down, and I'm just going to see how long this one was. And it was 2192, I'm going to call it. And we'll see. So this whole fifth wave was 2,616 points. Now I'm going to take 38% of that is 994 points. And we've already surpassed that. Because here we'd put us, that would take us above 3,800, which is where we're sitting. So yes, there's the possibility that C wave is done, but I just don't feel it, and it's not being confirmed. So then you go to the next. The next is going to be a 50% drop. And we're going to see if I can get input to this. Here's the 382, 3809. Here's the 50, 3,500. Now that we got, and we've got, first of all, we got the 200 EMA on the weekly at 37.38, which we kind of played around and we've been up and down through it. More importantly, we have the low at 36.36 or 36.37, but the 200 SMA is sitting right along with 50% retracement at 35.12. So again, in terms of what this all is doing coming off, that does provide support. But here's the other part. If I'm believing that this is minor wave 1 of intermediate wave C, we're going, folks. We're likely going to end up back down here. And you get a third wave. So I can add one more layer. And that comes in this form. This is on my weekly chart, right? And again, because I haven't put this in because it truly hasn't really come through yet. So, but it may. And if this is 1 and this is 2, and we're looking for a third, now you get to see where we're going. Where 3 would be equal to 1 at 2,900. So before we're thinking 35, okay, now that just slid, and the 618 slid, and we're down to where wave 3 would be equal to 100%. Then we get a 4. Again, this is within the concept of it's a minor 1, 2, minor 3, minor 4, minor 5. So where could we end up to put in this A wave on the primary degree level as a part of our longer term corrective phase? So where we are, what juncture we're in, and how you want to trade this is how the market's going to tell us. If indeed this caps off and we don't turn and start to run back up to get ourselves up towards 4,000 and a little bit above, and that would be within a minor wave 2, and I have to label minor wave 2 here, we're going to drop precipitously and hard. And it should take out that low at 36.37 and keep on going. It should take out 35.12, which is where that 200 SMA is, and then 3,500. It should head through these support zones until we get down into here, where wave 3 will be equal in length to wave 1. And then a little bit more would be nice. Then we get a 4 and a 5. Now that 5 can end up all the way back down here. So again, I'm into that price territory of the 4th wave, and but I'm looking for the primary, where primary A could come in. So it does fit, and the 4th wave continues to provide the support for the next one up. And if I'm looking for that C, and I'm putting an A here, and I get a B and a C, and that C brings us down to here, and that puts in the cycle wave A, or it takes longer, and we actually get the primary wave A down here, then so be it. But what I'm saying is that we're now in the hands of the market. The market will tell us, but it has to balance out with reality. That we cannot escape reality. And the primary reason is, in my opinion, is because we're dealing with interest rates. We're dealing with what controls our currency, plus currencies around the world. How much does it cost me to borrow? And how much can I get when I give it to you, when I lend it? Whether we're lending it to our government or lending it to whomever, you're going to receive an interest rate. How much is it going to cost to borrow, and how much is it going to cost to lend? And that's what it's going to be all about. So that's one scenario. I would be looking for the bottom of this C wave, and I can change it around. I still believe that this went up a little bit too high for me in terms of being a small 4th wave within this, and I can bring that all the way down. So I just think that it came up a bit too far, because then I have to switch this to 1, 2, 3, 4, and that kind of gets nasty. 5 or 3, 4, 5. Put the 1 here, put the 2 here, and then it's like 1, 2, 3, 4, and then we're going to slide back down and put a 5 and call it a 3. It's got a little bit too big when I compare it to that, which is why I put the 1 down here, and we're going this way. So that continues to be how I'm viewing technically this picture. The market will ultimately tell us, because the other side of the coin, and this remains active, folks, is that we go down. This is A, this is B, and we come up in a C wave. We end up here and then turn and fall off the cliff. So these things remain. And why? Because what's outside of all of this, affecting interest rates, is at this juncture in a wait and see pattern. The Fed meets again in September. So we got 2 months of banter, of talk, of economic numbers, of et cetera, et cetera. What are they going to do? Speculation. Second quarter earnings start in a 2.5 weeks, 3 weeks. So there's a lot still on the table that's going to cause a lot of motion. But we are starting to see, even within, folks, the components. Meta coming out, Facebook, Meta, AKA Facebook, basically coming out. Major tech titan. Made a lot of money real fast. and now is going to start redefining their hiring goals, whether they're really going to start adding to teams, also looking to get more from teams, et cetera, et cetera. Mark Zuckerberg himself laid out a whole big spiel about these are the changes that are going to be happening at Meta. And now we'll see what happens. What happens to the earnings? So what are the earnings in the second quarter going to show us? They got to start pulling that in. Why? Because cheap money is no longer available. So you can't just grow on cheap money because you can borrow it, build, hire, produce. Because if you're unable to produce, because the same people that are going to be buying into this have no money. It's a vicious cycle, but it's happening. And I think that what we also can do is, like, you, depending on your time frame, I truly cannot afford as a day trader to take on a bias. I can't be long, I can't be short. I can't go, I'm gonna, I'm longer term bearish. So therefore I've got to, continue to just build from the short side. That's foolish when you're trading futures. As a day trader in futures, you can definitely be super wrong and be down $1,000, $2,000, $3,000, $4,000, $10,000, $20,000, $30,000, all in the opening rotation. Just by not paying attention to price action, just by choosing to pick your point there for a long-term view. There are different ways to build a mindset to trade, swing trade, which could be a swing a month or two, could be a long-term trade, which is more you're looking for security and also a more sustained, smaller payback, I should say, and that could come from a dividend, that could come from an interest payment, et cetera, et cetera. There are ways to look at that. There are many ways to invest in, and so my thought process also goes to being prepared or having an idea of what could possibly happen begins to let us be prepared for it. There will be, in my mind, as a day trader, there will be plenty of trading between now and September and December. I think that there's a ton of money in the markets. And even as it's rushing to get out, there's a ton of money to be made as a day trader, as a short-term trader, as a swing trader, with options, with futures, with ETFs, with all of the products that are available. But folks, got to have a mindset. And honestly, you're going to be basing your trades. If you're an options trader, you are looking at premium and you're taking advantage of the premium. So in essence, what truly does happen right now is that trading becomes quantitative. It's not fundamental. It's technically quantitative. Because what's going to move the market now are moving averages, are Fibonacci numbers. And I'm using them, so are several other people, hundreds, thousands of other people, big firms, and they trigger. This is what gets triggered. And I'm on a daily. So we got them on triggering off of a weekly, triggering off of a monthly, depending on the mindset and the framework in which they're building a position. So longer term, I do feel the market will continue to move lower. I feel that we will finish the primary A wave and set the stage for a 2-month, maybe 3-month counter trend rally. And that itself will have an ABC. But it could be a flat, it could be a zigzag. There's several different forms, but it will happen. And the major point is to not try to determine, is this the one? Is this the one that's going to take us up to 10,000 in the S&P? Or is this the one that's going to drop us down to 700? I don't really care at this point. I know that people do it on a longer term basis, but you can do that prep work in advance. I'm not saying it's going to go to 200, but I'm going to tell you, my feeling is that we do have lower levels to fulfill on a longer term basis before the next larger, sustainable economic up cycle expansion takes place. We're correcting too much overkill, too much over extreme, pushing interest rates and borrowing tons at those levels and throwing it back into companies that have to earn money, that have to, it's a huge cycle, and it's a huge circle. And so without the availability of that cheap money, you can't keep running at the levels that you have corporately. So Apple has to take a breather. Meta has to take a breather. Google has to take a breather. Amazon already led you on by saying that they had lost $6.8 billion last quarter. It was because of inflation. It was because of the increase, and it cost them to get that dang package to us in 24 hours. So a lot going on. Repricing, you've heard me speak about it. It's still happening. And I can't tell you how much or how deep of what it's going to take. But what I can do is compare the current situation, interest rate wise, inflation wise, compare it to the last period where we had inflation that high, and where were interest rates and what happened. A lot happened back then. But more importantly, it's just being prepared. And it's also understanding, well, to go back to 1980, 81, what was my life like? Well, wasn't that bad. I was, trading and making good money. It was a different world. It was a different set of circumstances. Pricing was totally different, And so what we paid for a house, what we paid for rent, what we paid for utilities, totally different than 2022. So we ignored inflation and allowed it to create it because we kept throwing money into the market, into the system, large amounts of money. Now that can't happen. I was like, oh, how are we going to keep it up then? We can't. What happens? They got to come down. All right. I hope what I've said starts to help in building that larger picture, just in terms of what our potential is, where we could get to. This would be like phase one, primary wave A, then we get a primary wave B, and then a primary C wave. Maybe that brings us down into here, maybe even all the way down to there. But I think you can get into here. I think the SPX can get down to maybe 3,000-ish, maybe. Excuse me, not 3,000. Can get down to 1,100. Yeah, here it was. And still be survivable, even if we got down to that 2009 low. If we drop somewhere in between here, 1538 all the way down. I think I had one that I thought was like at, I'll figure it out and put it together. So, but I'm thinking that we can get 26, 25, 26 for an A wave, and then a B, and then a C, and the C wave should surpass that. And then we've got the next level up. So we got to finish off the intermediate C. That'll give us the primary A. Then we get the primary B and the primary C. That gives us cycle wave A. So I'm looking for cycle wave A. So ultimately, folks, yeah, I do see that. But you're going to see we stair-stepped on the way up under Elliott. 1, 2, 1, 2. We got a 3, 4, 5. We did ABC. 1, 2, 1, 2, 1, 2, 3, 4, 5, etc. That stepped all the way up, and now we're stepping back down. But in the same degrees, we got to go back down by degree. So again, we get the intermediate done, then we got the primary A, then we got the primary B and C. We got the cycle wave A, cycle B, cycle C. Then we've got, I basically could almost say we've got the super cycle wave A, but I'll reserve. And then another B and another C till we get a super cycle, but we're not in the super cycle. I'm only looking for super cycle, a grand super cycle. I'm only looking for the super cycle 4. So there's an ABC of cycle, primary, and intermediate degree. It's going to be interesting. And I hope I've been able to at least contribute some thoughts to how I put my bigger picture together, how I now start to translate that down, what I'm looking for over the next 3 to 4 months. 3 to 4 months, maybe 5, maybe 6. This goes out. This takes a while for all this to unfold. And this is where I'm going to conclude it. Thank you so much for joining me this evening to take all this in. And I will, again, make another, but just a normal Elliott Wave update tomorrow afternoon after the markets open on July 4th.